Good morning to all the SIR Group audience. Welcome to this SIR Group webinar, the Scared to be In, Scared to be Out webinar. We welcome you and we welcome the panelists. I'm handing over to Keith Isaacs of the SIR Group. Keith, over to you.
Thanks, George. Morning, everyone. Today's webinar focuses on reviewing portfolios for our investment clients. As a group, we have committed to doing 3 ongoing reviews a year with all of our lump sum local and global investors. One of these reviews is a personal face-to-face or digital meeting with your financial planner to look at your portfolio. Alongside your personal reviews, we hold 2 additional annual webinar-based portfolio reviews focused on portfolio performance and strategic allocation in the current market context. Here we'll give you an overview of the decision-making process that goes into growing your portfolio. This is a 3-part webinar today. Firstly, we'll have some market commentary from the panel. Part 2 will be looking at your portfolios, which is the main reason. And part 3 will be to introduce a guest speaker today. Mark, to kick things off, I'd like to introduce Mark Biaggi, CEO of SIR Group. Mark, often in discussion with our clients, it's become apparent that the concept of a DFM or discretionary fund manager is not fully understood. Can you simplify this arrangement?
Morning, Keith, and welcome again to all our viewers. I see some new names on the attendant list, which is great to see. For the repeat attendees, please excuse the next few seconds as this is going to be a little bit repetitive, but I think it's important that you understand this concept and the question that Keith just asked. Because most advisors don't fully understand portfolio construction, there's been a market trend both globally and now locally for financial advisory firms to partner with a discretionary fund manager or DFM. I'm sure you know by now, we've partnered with a very well-established firm called Martin Optimal, due to their great track record and their depth of expertise. The role of the DFM, Keith, to answer your question, is to do all the due diligence, the investment research, implementation, and administration of our portfolios, so that we as financial advisors can focus on our clients' requirements and propose the most suitable solution for them. In other words, stick to our strengths, do what we need to do for clients, and allow Martin to do the management of the underlying portfolio for clients. I think the slideshow on screen illustrates this simply and what I've just said. So the typical model in the market is a financial planner will see a client, they'll look at product providers like Momentum, Old Mutual, Discovery, Liberty, I like to say blue, yellow, green, purple. And in some cases, the advisor is tied to one of those product houses, or as an independent advisor, they can choose out of those product providers the most suitable product or solution. Then it comes to the underlying fund selection. And as I said earlier, most advisors aren't qualified investment or asset managers. And so for them, they tend to pick one of the following. You'll see Allan Gray Balanced, Coronation Balanced Plus, 91 Balanced Foot. These are the household names. I like to say, take some spaghetti, throw it against the wall and see what sticks. They'll do an annual review at the end of the year and basically hope that their selection that they put together works for the client. In our space at SIR Group, what we do differently is we have licenses with the same product providers, Old Mutual, Discovery, Liberty, etc. Client might have either favoritism towards yellow, green, red, or blue, or we'll look at it from a pricing and servicing point of view, choose the appropriate product. Then instead of the household name funds throwing against the wall, we utilize the expertise of Martin Optimal, who go and build or construct a portfolio for us using informed global market research, analytics, a team of experts with long-standing or a history of great performance and expertise. I think, Keith, that answers your question.
Yeah, thanks, Mark. I think that really simplifies things for the guys. I'd like to call on Roelof. Roelof, as Chief Investment Officer, you're constantly looking at what's happening in the global marketplace. How is it affecting us in South Africa?
Keith, it's a long answer, but I'd like to start by quoting the title of our overview: "Scared to be in." That's scared to be in the market, and scared to be out of the market as well. So why are we scared to be in the market? Well, we all know that the Mag 7 stocks, the Magnificent Seven stocks, they're all AI large players in the market. They 35% of the S&P 500, so large concentration risk. They are expensive, but yes, their earnings potential are great, but they have run hard. So a lot of commentators feel that the market needs to take a breather. Yes, we actually did take some profit in the last week and reduced our equity exposure globally. But markets cannot go up in a straight line. So tonight, for instance, Nvidia is announcing their earnings results, and it will be a catalyst for maybe the next couple of weeks until the Fed decides what to do with interest rates. So all these uncertainties, yes, make us scared, but there's other uncertainties too. And it's like the geopolitical risks globally, which we all know, massive budget deficits, whether it's the US, Europe, Japan, even China, and the talk about fiat currencies, and is it safe to invest in the dollar or in other large currencies like sterling, euro, and the yen. But why are we scared to be out of the market? And this all will lead back to South Africa as well, is GDP growth, whether it's the IMF or World Bank upgraded GDP growth globally to 3%. That tells you should invest offshore because there's a lot more opportunity. South Africa at a growth rate of just over 1%, but some green shoots appearing in South Africa. The reality is that the US, Europe, Japan, China, Germany are all in fiscal stimulus mode, either for protection purposes or to save their economy or to maybe spend money on, like in Europe, aerospace, defense, industrial developments, and then in Japan to stimulate the economy. So that's really good for risk assets. But the reality is these massive budget deficits, which makes people scared to invest in currencies and their bonds. And that's another reason scared to be in long-dated bonds, for instance. But the reality is these governments can't afford high interest rates. If you have too much of a interest bill, it means you need to pay it. And if your government income is not enough, you need to cut rates to make it more attractive for you to actually service that interest. So the big theme is that interest rates globally are normalizing lower again. And that can also affect South Africa with lower rates and make money market investments less attractive. It's been safe over a long time now, 10 years in South Africa, to receive between 7 or 8% in fixed income returns, depending on the cycle we were in. But interest rates can go down by about 0.5% in South Africa. Inflation is anchored in South Africa to close to 3%. No threat in terms of oil or food inflation in South Africa. So rates is going to come down, and that also bodes for the offshore environment. The US has cut rates, but slower relative to other emerging markets as well as other developed markets. And the key takeaways, and this is summarized here in terms of the slide, is that the US still leads. It's still, people don't want to know it, but the US economy is still the strongest economy in the world, the most efficient economy. And yes, there's a massive Gini coefficient in terms of who earns more and who earns less, and the middle class is suffering, but there's a lot of wealth in that economy and a lot of productivity growth due to AI interventions, and definitely corporate profits and margins have improved due to AI use in US companies. Important, yes, tariffs are an issue. It's starting to fade away. And yes, employment data are issues. And that's what makes us scared in terms of the potential going forward. Tech and AI, definitely an industrial revolution. coming, and then that leads to productivity enhancements, energy transition themes, Europe emerging markets looking really attractive. And yes, when it gets to in fixed interest, we need to be in short-dated bonds globally as well as locally. And we've also invested in protection strategies, especially our local market that has done very well. But these global forces do bode well for the SA risk assets, but the opportunities still remains offshore. I hope that answers your question, Keith.
Yeah, really, thanks very much. The vibrant market information really gets the investment juices flowing. Great market commentary. Thank you very much. So part 2 of the webinar is where we look at your portfolios. You guys who have logged on to come and watch this. I'd like to call on Jacques, your head of portfolio management, Martin. Please, can you showcase the performance of each of the local and global portfolios for us?
Great, thanks, Keith. So if we run through the SIR Group model portfolios, just to start off with, Martin Optimal has created a suite of portfolios for the SIR Group to kind of fit into whatever risk profile the client might have. So if we look at the local range, you're looking at the income plus, the defensive, balanced plus, and a growth portfolio, all of them with very specific asset allocation to suit the requirement, not just return, but also risk and volatility of the specific client. If we then look at the offshore portfolios, there's also a balanced and assertive portfolio, also with the relevant asset allocation to suit specifically what type of return and what type of volatility you as the client might require. So if we go down to the local portfolios, and this is what we're here to chat about today, the local portfolios specifically have performed very well over the last year to date, and specifically over the last 3 years. But what's very important when looking at performance is relative to something. So what I have here is a slide where on the x-axis, you're looking at how volatile a specific asset or portfolio have been. So what you see in blue is the SIR Group portfolios ranging from income plus to growth. And what you can see in green is Steffi, bonds, the capped Swix all share, as well as listed property. If you look at the y-axis, you'll see the higher you are on this axis, the more return. So effectively what you want, when you look at what we call the market line, if you connect cash and all of the risk assets, where you preferably want to be with the portfolios, because these portfolios use those asset classes, is to the left of the line, because that means you're less volatile, and higher above the line, because that means you got more performance. And that's why being left and high, we like to call this the Bob Marley portfolios, and it certainly lived up to that expectation. And I apologize for those of you who've heard this joke before. I am known for writing a joke out maybe too long, so you can look forward to this one in the next presentation again. But if we look at the actual performance of the portfolios versus benchmark, you can see, and I'll go through the numbers now, but you can see the outperformance over the last 5 years and inception. The blue line being the portfolio, and the green line being the relevant benchmark that we use to measure these portfolios. So you can see straight through nice outperformance. But if we look at the numbers specifically, you can see year to date, 1 year, 3 years, really good returns. And I compare this to Steffi specifically, because if you look at cash and what cash can give you, clients do tend to want to look at cash when looking at relative performance. So one thing that you'll notice here, as you go from income to growth, you have an increase in your return year to date, 1 year, 3 years, and the returns being quite good, even in the income plus. This is something, giving the theme of scared to be in, scared to be out, maybe something that is not something that you should definitely look to in the future. The 5-year type of returns is more your longer term averages. So it's been a wonderful year. Risk assets has given us returns, and bonds and cash has given us great returns. So we're very proud of this. but maybe curb the enthusiasm in the future, given what market returns could be. If we then look at what these portfolios have done since inception versus cash, you can see one, if you invested into cash specifically versus taking the risk, sticking out through the long term, you definitely got the benefit. And also, as you ratchet up the risk scale, you get compensated for that extra volatility that you're taking. So straight through, good performance from the local portfolios, outperformance of cash, and just be sure to curb the enthusiasm maybe in the future. All right. I think, Mark, you said you had a question that you wanted to go through.
Yeah, Jacques, sorry to interrupt. I know you're going to move to the global portfolios, but I think this is really relevant. A common question of late coming from our clients, whether that's in consultation or quite frankly, even at the bar with mates, if it's not the performance of the Springboks at the moment, it's the appreciation of the rand. I think, and the questions coming is, with that appreciation, is it a good time to invest offshore? And I know you're going to get to the global portfolios. Roelof, can you maybe you alluded to it earlier a little bit, but can you mind adding a little bit more context to this topic?
Look, if you go to this the long-term trajectory of this, the rand, Mark, just move on to that slide. You would expect from an economic perspective, if your inflation rate's higher than your developed market trading partner, you have to depreciate your currency. And this you can see in the rand. Our inflation has always been higher relative to the developed world. Our political scenario, economic scenario, all tells you that the rand should, over time, depreciate. What's happened lately is that the dollar actually lost its value. The dollar had about a 10-year bull market relative to all currencies. And due to a little bit of mistrust from the West, so East, relative to the US, there is a move of dollar de-dollarization, and central banks like China, India, Russia, and the rest of the world has started to buy gold instead of US treasuries. That has really affected the demand for commodities, the appreciation of the rand lately. And yes, it may continue. Just a very important point. The reason why we feel one should invest offshore is not all about the rand. It's about the opportunity set. We mentioned GDP growth of 3% per annum globally. Our local portfolios are between 35 and 40% invested offshore because it's the right thing to do. There are more opportunities, whether you look at energy as an example. Banks are cheaper in Europe relative to South Africa, despite our banks being really well capitalized and being attractive. You can also generate a lot of extra income globally from non-AI stocks like Chevron at a 4.5% dividend yield, US Parcel 5% dividend yield. There's a lot of reason to actually diversify offshore other than the rand. We will be serious buyers of global assets at about 16 to the dollar. And so at the moment, it's always an opportunity when the rand has appreciated to use the opportunity to diversify offshore. And please, when you invest offshore, let's then measure your portfolio in dollars or in sterling, whatever you prefer. We manage both currencies. And forget the fact that you've used rands to invest offshore, because the rands, as you can see on this graph, is a very volatile instrument. But the best reason to invest offshore is the opportunity set and to diversify your total portfolio.
Yeah, stunning. Thanks, really. Jacques, I think let's carry on with the actual global performance, if we can.
Right, thanks, Keith. So if we go to the global, the offshore model portfolios, as I said, there were those two portfolios, the balanced and the assertive. Once again, great outperformance. This is a graph over the last 5 years. Great outperformance of the relative benchmark. The various asset classes and the tactical tilts that we employed into these portfolios really paid off. So we're very happy with the performance. And especially, once again, if we look at relative performance relative to what cash plus 3 in this instance, because we feel it's a good relative benchmark to use for a client perspective. Very nice outperformance. You got the returns that you wanted, and these returns are in US dollars. Year to date and 1 year, exceptional returns. Once again, scared to be in, scared to be out. It's a good idea to not expect this level of returns going forward in the future. Once again, the 5-year returns is more or less a good barometer of a longer type of return. As you can also see, these portfolios are a little bit more volatile, but very important what Roelof mentioned as well. Keep in mind that we do track these portfolios in dollars and not in rands. But similar to the local side, good performance, outperformance of the benchmarks, and outperforming a cash relative return profile. So that's all from our side. Keith, I'm going to hand back over to you now.
Thank you, Jacques. That's very thorough. If any questions, I'm sure that we'll get those questions from our clients. I am now going to introduce part 3 of today, our guest speaker. And our guest speaker today is Annika Faul from Overseas Trust and Pension, or OTAP. Welcome, Annika. Just a quick introductory. OTAP, Overseas Trust and Pension, is a company who offers a range of innovative international financial products designed to protect, preserve, and grow your wealth. Since 2006, they've specialized in pensions, trusts, retirement solutions, and employee benefits, and remain the only regulated foreign pension provider in South Africa, offering international pension services. Annika, you hold a BCom in International Business, and you head up OTAP's International Business Consultancy Division. So how long have OTAP been doing business with South Africans?
Since 2006, but we've seen our products booming from 2015 when the foreign investment allowance was increased from 4 million to 10 million. So there's always been a theme of clients wanting to send funds offshore. As to fit in with the theme for today, people were scared of leaving their assets, all of their assets in South Africa, but also scared of sending it offshore in an unprotected environment, and that's where we step in.
100%. And what are the solutions or services that OTAP provides?
So we do international pensions based in Guernsey, as well as offshore trusts. So we do both solutions. And mainly what it does is we service clients wanting to externalize their assets offshore in a safe environment. Clients with offshore assets after they've lived and worked abroad and coming back to South Africa. Clients with offshore beneficiaries where they are resident in SA, but they have offshore beneficiaries, or just South Africans wanting to emigrate, maybe to Portugal, Spain, Australia. We offer solutions for them on the other side to make it more tax efficient for them.
Okay. And the difference between the trust and the international pension solution for South Africans? Just a brief information. Or you can actually be quite, if you want to extrapolate, please go ahead.
Okay, perfect. So we do offer both offshore pensions and offshore trusts, and it all depends on the clients on a case-by-case basis. Their requirements, what they need, is it succession planning, legacy planning, or is it retirement income needs? But I can compare an international pension or an offshore pension and a trust by 3 different ways. So assets going in, what happens during the lifetime of the trust or pension, and then assets going out. So going in with an offshore trust, you either have to settle the trust and pay donations tax, or you have to set up a loan account and then you'll pay income tax on the interest of that loan. So that's for an offshore trust. With an offshore pension, you don't have that. Only you as a member can access the benefits. So there's no donations tax because you're not gifting away the assets. And there's no requirement for a loan account because it's not a trust. So that's going in, that's the main big differences. So pension is easier in that sense. And then during the lifetime of the pension and offshore trust, because ours is based in Guernsey, Guernsey is a tax neutral environment. So during the lifetime of the pension and trust, there's a roll-up environment. So there's no income or capital gains tax being deducted. So that's in that essence, it's the same during. And then for assets going out, so when you make distributions from a trust, it all depends on the nature of that distribution. If it's capital, then you won't be taxed. If it's growth, it all depends on what type of growth it is. Is it capital gains or is it income? And then you'll be taxed differently that way in South Africa. You won't be taxed in Guernsey, which is good. And that's the same as well with pension schemes. As long as we pay out lump sums, and then we can pay out capital first, which we won't be taxed on, and then your growth would eventually be taxed. So it's a tax deferral, which provides a big benefit. And then when clients pass away, currently the pension scheme is not estate dutable, so that's also a big benefit. And with the offshore trust, you've technically already externalized those assets outside of your estate when you contributed to it, so that's also not estate dutable. So it offers similar benefits, provides asset protection as well, seamless succession, but in a nutshell, it's easier going into a pension, and then you can always use a trust as part of the succession bit at a later stage.
Sure, those are awesome benefits, and longevity and great succession benefits as well, which is really, really nice. Annika, you mentioned Isle of Man and Guernsey, and we noticed that a lot of our local companies like Momentum, Old Mutual, Discovery, they all have offshore branches in Isle of Man or Guernsey. Why these locations?
It's highly regulated. It's also very, very stable, and that provides certainty for clients. And then also it helps that it's also tax neutral or tax friendly.
Yeah, I think we're living in a very tax-hungry society, unfortunately. It's one of those things, yeah. And okay, thank you very much. That's very, very insightful. And I'm sure that anyone wants any more information, you're freely available to come on to like a chat, etc., etc. So thank you very much for that information. Mark, any more questions? Has anyone come up with any questions?
Yeah,
at
Keith,
all?
thanks. Another question of late and a topic to chat about, I think, is South Africa's removal of the grey listing. George, can I pick on you to comment about how this affects us both as advisors and clients? Does this provide more opportunity for clients to invest offshore?
Yes, Mark, I think it's a very relevant question. The Financial Action Task Force is a organization that sits in the offices of the Organization for Economic Cooperation and Development in Paris. And their function is to ensure oversight and global standards around anti-money laundering activities, as well as anti-terrorism activities, plus to ensure that there is oversight and financial discipline at countries around the world. So to come off the grey listing, which South Africa was on for 33 months. So we were placed onto the list in February 2023, and we officially came off it on the 24th of October 2025. So you know, are you in or are you out? This is the time to be in, without a doubt. So what it does essentially is it increases our global reputation as a country. It reduces the cost of doing business. It simplifies the process of helping clients invest their money offshore, and it reduces that cost as well. It increases foreign direct investment into South Africa, which has a huge impact on the economy of South Africa. Without foreign direct investment, our economy simply cannot grow. It also demonstrates foreign, financial stability of the South African marketplace. And as I said earlier, it stimulates economic growth. So this is a very good thing for the South African market.
Thank you, George. Great answer. I think that's 30 minutes on the dot. So in closing, big thank you to everyone who's given up their time to be with us this morning. As we promised, short and sweet. Thank you to the team for your input and your continued support, Martin. On that note, just a quick special mention. Congrats to Martin Optimal on being awarded the CityWire DFM Servicing Award for 2025. Well done to your whole team. Very proud to be associated with you. Lastly, please, clients, follow us on social media if you haven't already. There'll also be a recording of this webinar. Please share it to your friends and colleagues. Thanks again and goodbye.
Thanks, guys. Thank you very much.
Thank you, everyone.